This is the average home price in Raleigh, North Carolina in August of 2024. So the question is, how can we afford this for little to no money down? In today's video, we're going to be interviewing a friend of mine, Mark Kong, who's been my personal loan officer. Mark is a co-founder of Evolution Mortgage, which is a small lending company dedicated to providing the best rates and customer service to their clients. Within 1 year, they have literally tripled the size of their coverage within the United States. Just last month, they closed over $20 million in loans. They're experts in the VA loan, conventional loan, and FHA loan. So Mark and I met before I went under contract for a duplex located in Raleigh. He also has an Army background, commissioning out of West Point in 2015, where he served for 4 years as an infantry officer. During this time, he started his real estate roots as an investor, a real estate agent, and eventually wholesaler. Eventually, he built upon that foundation by becoming a licensed loan officer in multiple states. So today, we're going to rely on his expertise to navigate how you can buy a home in the Raleigh market with little to no money down. Afterwards, he's going to share his thoughts on what sort of risks come with lending and how you can mitigate those. So for both new and returning home buyers, this episode is going to be value-packed with loan knowledge coming from an expert himself. So with that, let's get into it. What's up, Mark? How's it going?
Good. How are you?
Doing pretty good. Yeah, thanks for being on. Just going to get straight into it. I drafted a couple talking points. Feel free to take it wherever you want. But the main goal of today is to talk through options for people to buy homes with either no money down or low money options.
Yeah. So big misconception probably from our parents' generation is that you have to save 20% in order to buy a house. If you do save 20%, that's great. And I don't discourage someone from doing that. But you could buy with much less money down in today's environment. And it usually makes sense to, right? Because if you can get into a house early with low money down and you buy a house 4 years earlier than if you were to save 20% down, that's 4 years of principal payment you've made. That's 4 years of appreciation, et cetera. Rarely does it actually make sense to wait till you have 20+% down versus buying now, right? Granted, we don't know what's going to happen in the future. It could be market corrections, et cetera. But typically speaking, it's better to buy real estate early and often. So with that being said, options for low money down. Conventionally, we can go down to 5% typically makes sense, right? 5% down conventional. And then we can go below that for conventional. We can go conventional 3% down for a first-time home buyer. There's even programs to go conventional 0 down, where you get a sometimes forgivable, sometimes not forgivable second lien that covers that initial 3% down. Sometimes you have to be below certain income limits. So even just within the conventional realm, there's options all the way to 0 down. Okay. Especially if your realtor can go out and get seller concessions to cover closing costs. Now it could really be very, very, very little money out of pocket. And that's just on the conventional side. Then on the FHA side, we can go down to 3.5% down. And even within FHA, 3.5% down. Likewise, certain programs to help cover that 3.5% down. They're not as common. And typically when we go FHA, the borrower is just bringing 3.5% down. So what I typically tell clients is, hey, conventional, it probably makes sense to go 5% down conventional. For FHA, probably makes sense to go 3.5% down. Beyond that, there are niche programs, but that's generally speaking the best options. And then for veterans like you and myself, we have the VA loan, which is just an absolute trump card. A lot of people don't know this, but VA loan is probably going to have a better interest rate going 0 down VA than if you did 30% down conventional. It's insane. Why is that? It's because you have a billionaire uncle co-signing for you, aka Uncle Sam. And there's no benefit from a rate perspective to go 20% down VA versus 0% down VA. So the VA loan is the best loan out there to go 0 down, maybe even convince a few people to join the military just based on the possibility of having a future VA loan eligibility.
And for the 5% down conventional option, does that require a mortgage insurance or is that just a special thing for first-time home buyers?
So anything less than 20% down does require PMI, private mortgage insurance. Let's talk PMI and let's talk FHA versus conventional. For FHA, the PMI is a fixed factor. So you're going to pay the same PMI on FHA loan, whether you have an 805 credit score or a 680 credit score. On the conventional side, the PMI is somewhat correlated to your credit score. So if you have an 800 credit score on conventional, your PMI is going to be significantly less than if you had a 680 credit score. So oftentimes what I'm seeing is they have about 5% down and they're between FHA and conventional. I just run the two scenarios for them and say, hey, here's what FHA looks like. Here's your monthly PMI. Here's what conventional looks like. Here's the PMI. And what oftentimes see is people below the 700 mark, they're better off going FHA, at least in the short run. And people that are 700 above, especially if they're 750 and above on conventional side, they're much better off going conventional because that PMI factor is correlated to their credit score and it's quite favorable. The other thing is that FHA, that PMI is never going to fall off. It's for the life of the loan. So even no matter how high the house appreciates, etc., that PMI is going to stay on there. On the conventional side, once you hit 80% loan to value, and that could just be based off of appreciation, you simply send documentation to the lender, right? You may have to pay for an appraisal, worst case scenario, and that PMI you can cancel after that point once the lender approves it. So the fact that conventional, you could essentially just have the PMI fall off when you hit 80% loan to value. Especially anyone with favorable credit, it's probably going to make sense to stay away from the FHA loan.
I feel like I actually know a decent amount about mortgages, but I feel like even now I'm actually learning stuff. Good
For
thing,
sure,
yeah.
yeah.
See, this is the point of having you on here because I didn't know that you could request to have your PMI come off
Hmm.
for conventional specifically. I just assumed it was like with FHA, it actually stuck with it. Yeah,
Yeah.
that's interesting. And appraisals still running roughly 500 even for that.
Yes, but typically you don't even need an appraisal. Like you could probably just run a smart report or like what's called a desktop appraisal, and pay. I'm talking less than $200 out of pocket to show that the value's increased and send that into the lender. And they're most likely going to accept it. Worst case scenario is you pay five, six, $800 worst case for an appraisal, a full appraisal, but that's not even necessarily usually needed or required by the lender to drop off PMI.
Okay, I gotcha. And just sort of to ask the probably more obvious follow-on question, it's pretty much implied that VA is exempt from the PMI. Can you talk
Right.
us through that? Like, is it any unique considerations, or is it just plain and simple, 100% loan to value and never PMI?
Yeah, VA loan is definitely best of both worlds, where you got the favorable rate, no down opportunity, and then no PMI as well. So the VA's form of PMI is they charge a funding fee, which is not too crazy, and that funding fee can get wrapped up into the loan. So it's 2.15% for first time use and 3.3 for subsequent use. And then veterans who have any sort of disability they're receiving from the VA, they're exempt from the funding fee. So there's even veterans that could have a 0% rating, but they're getting a little bit of money from the VA for something small. They're even exempt from the funding fee. And then for active duty folks, pretty much the only people who are exempt from the funding fee are folks with a Purple Heart. And so if you don't pay the funding fee, then it's even better. But that's the VA's way of kind of having some mortgage insurance. They use those funding fees to essentially have an account that kind of acts as their way to guarantee the loan.
Interesting. I didn't know that about the Purple Heart either. VA between the three is sort of a obvious winner. But then if you had to choose between VA or conventional and FHA, you would choose conventional 5% down if your credit score is fairly high. And then if not, then FHA is probably the better route. Does that more or less sum it up?
Those are good guidelines. Yeah,
Okay.
those are good generalities. The FHA versus conventional is a closer battle and more nuanced. So there could be someone even at 720 or 740 credit score, and just depending on the scenario, it actually makes sense to go FHA. So anyone in
Hmm.
that scenario, once they go under contract, then it's just like, hey, here's side by side comparison. And then even if conventional is slightly less favorable, it might make sense to still go the conventional route because the appraisal requirements are a little bit less, it's a little easier to close, and their PMI is going to be able to fall off. So even if they're neck and neck, I would bias conventional, but FHA is really good loan product, especially really good loan product if you are in the lower credit score bracket. Because that PMI or that, let's call it mortgage insurance, it's not called PMI for FHA, it's called uh, slightly different term, but that mortgage insurance is the same regardless of credit score. And so if you have a lower credit score, it's actually kind of a good thing that that mortgage insurance is just a fixed amount.
Yeah, the FHA could also, I mean, I guess this is true for any of the residential home mortgage products, but FHA could cover up to a quadplex, right? So you could
Correct.
buy, in theory, because I know there's stipulations to it, but in theory, you could buy a quadplex, up to a quadplex. Is there a reason in that regards to go with FHA over conventional, or is it honestly just the same consideration?
Yeah. So if you're going threeplex or fourplex, there's actually a reason to go conventional over FHA. And that's the fact that a lot of people don't know this. And you'll see a lot of gurus online that are like, just use your FHA loan, buy a threeplex or fourplex, and they don't get into the nuance of it. Well, for FHA, a threeplex and fourplex has to pass the self-sufficiency test. People don't know about the self-sufficiency test, and it kills a ton of deals. And what does the self-sufficiency test say? It says that all the rents for, let's say, a fourplex, rents received times a 0.75% for vacancy factor has to cover the PITIA. That's the principal, interest, taxes, insurance, and any sort of homeowners association. So when interest rates were 2.5, 3%, everything was passing the self-sufficiency test. Now that interest rates, had gone up into the sevens and sixes, and maybe now we're in the high fives, almost nothing is passing the self-sufficiency test. But as rates come down, or I should say, as rates start to come down, and the Fed's kind of indicated that they'll do one rate cut on September 17th, 18th. We'll see how much it is. Hopefully we see more properties pass that self-sufficiency test. But if it's close, or even as realtor, you kind of get a ballpark for it. If it's looking close, you definitely want to go conventional because FHA may not pass that self-sufficiency test. And for conventional, what was pretty unfavorable before is to do multifamily conventional, we had to do 15% down. We couldn't come down to 5% down. And they changed that guideline within the last year or so. So now we could do conventional 5% down. It's a big change. And so, yeah, I would say for threeplex or fourplex, we're probably better off going conventional over FHA. Duplexes don't have to pass the self-sufficiency test. For duplexes, FHA and conventional might be more neck and neck.
Interesting. That's a pretty brutal vacancy rate that they're comparing. 75% occupancy throughout the year.
Yeah.
For a long term.
Yeah, and it doesn't. Right. And it doesn't go off of current rents. It goes off of what the appraiser puts on the appraisal report of what each unit should rent for. So there's also subjectivity where you could win or lose based off of what the appraiser thinks they should rent for.
Interesting. Yeah, that could be very inconsistent then, I imagine, by area, whether or not there's good comps or not, for example.
Yep, totally.
There's one more loan that comes to mind. There's a lot of people moving here, and there's not enough space in downtown or high density housing. So like many places, suburban places pop up, but a lot of those places are actually being built on farmland, and North Carolina is traditionally known for agriculture. And so naturally, things like the USDA loan, depending on where you live, could be an option. So can you talk that and some of the nuances? Because I'm aware it exists. My sister used the USDA loan. I've never helped a client with the USDA loan. So I pretty much only know surface level knowledge about this.
Yeah, USDA loans are more of a unicorn. We don't do a ton of them. So you can go to zero down USDA loan. And the biggest thing is just eligibility based off location. So for USDA loan, step number one is just getting on the map and seeing by location if it's eligible for USDA. So that's the starting point. And then after that, the qualifications go beyond that. But number one is just looking at the map. Not a lot of areas qualify for USDA loan as far as where people actually live, because people actually live in cities for the most part, but it is a low money down option. So yeah, I'm glad you brought that up.
Is there also the same sort of mortgage insurance consideration as FHA, or is it more closely resemble VA or conventional?
Ooh, I actually don't know off the top of my head. I'm not a USDA loan expert, so I'll have to look that one up and get back to you. Yeah.
I gotcha. I mean, it's not it's really
it really
isn't.
Loan. Yeah.
And honestly, I mean, this is probably a bit more of a fleeting opportunity out here because since Raleigh is one of the top relocation spots, I don't know how long certain areas would qualify for it. Well, the next thing I want to talk about is risk. And I think there's a couple times in which you implied some risk, but I like to view buying homes as a decision-making process. And part of your job, besides just developing options, is to identify and mitigate risk. And so can you talk about some of the risks that you would recommend people do consider? I mean, I guess you could call this even just a pros cons of the different loans, like an example being lower money down could equate to a higher monthly payment, right?
Right.
Not that that's a bad thing. It's just something that somebody should know, right?
Yeah. So the biggest risk I think buying is just like if you have to sell, right? So the more money you put down, the less risk you have of essentially being underwater. The less money you put down, the more risk you have of being underwater. So, for example, if someone bought with VA loan, they went zero down as a subsequent purchase at $300,000. Well, what's going to happen is out the gate, their loan's going to be about 310,000. So their house is currently worth 300 and their loan's 310, right? And let's say they're active duty and they're moving duty stations in a year or two. If they were to go to sell that house, it may not have appreciated enough. Plus, let's say to sell, they need to pay closing costs, realtor fees, etc. They could be at a point where they can't sell. So if you buy with low money down, whether that's conventional FHA or VA, I'm just highlighting VA because it's the most stark, because you can do the least amount down, plus you could finance the funding fee, which you can in FHA as well. It can result where your loan balance is higher than your equity. And then even if your loan balance was equal to your equity, right, selling costs money. You have closing costs, realtor fees, etc. So the biggest risk I see is if someone's not ready to be a landlord, if they're month to month on their expenses, they don't have money saved, they have HVAC go out or something, they can't recover from that. That's probably the biggest risk. What's going to happen is they're going to, have to become a landlord. If they move, they don't have the option of selling, or their only option of selling is being thousands and thousands underwater. So you just have to make sure you're ready for it, because over time, that loan balance will come down. Over time, the house will appreciate and they'll be in a healthy spot, but it takes time. And so if you're going to buy a house zero down and stuff like that, are you ready to, and with interest rates being high, it might be negative cash flow a bit as a rental, right? That in whatever market you're in, you may not be able to, your mortgage may be 2,500 a month, and maybe you can only demand 23 a month in rent. So out the gate, you're negative 200 in rental income per month. Again, over time, rents will increase and that mortgage will stay the same. So over time, it should become cash flow positive. But can you weather that storm? It's just much harder to buy and much harder to have healthy rental, right? Like, even on the investor side, investors were used to seeing a higher cap rate and now they're settling for much lower cap rates. Same thing on the individual side. So I still believe in buying real estate early and often, right? As I say, but it's not as pretty as it was 3, 4 years ago. Speaking of, is it going to get better? Should people wait to buy? Because that's like when we talk decision making, that's always the decision that's on a first time home buyer's mind, especially, and even a second or third time home buyer's mind. Should I wait for the bubble? Should I wait for the correction? And I think people that wait now are going to be waiting their whole life. There's no help coming, in my opinion. Where affordability is right now, affordability has gone to the trash. And like I said, if you buy a house now and then convert to a rental, you're probably slightly negative cash flow. The assessment that a bubble is just going to happen and things are just going to go back to being not perfect, but much better is, in my assessment, a false assumption. Affordability has gone to the trash, but I do not believe it's going to get better, right? And what I think people make the mistake of comparing America to America 5 years ago or America 10 years ago. And what people should probably be comparing America to is Canada and Europe and Asia. And like, by and large, these are rough figures, but Canada is about 1.5 times less affordable than America. Europe on average is about twice as unaffordable as America. So, you kind of have to, a borrower kind of has to look themselves in the eye and say, do I think America is going to go back to America 5 years ago, or are we going to approach Canada and Europe as far as on affordability? And that's the direction I think we're going to go. We're not going back to the promised land. It's just going to get uglier and uglier. And buying a house in America is actually way easier than buying in other countries. And, as we keep going year over year, I think it's just going to keep getting unaffordable. I don't think rates are going to come down too much. When rates do come down, I don't think house prices would stay the same, right? House prices are going to jump back up. So the affordability is just kind of gone. And the folks that don't buy now and they do buy in 5 years, don't think it's going to be a fun situation.
Yeah, I mean, that makes a lot of sense to me. One of the things that I'm always trying to tell people is to approach it from, like, if you meet certain criteria, certain thresholds, like enough cash to close, obviously, right? Like, you have to put due diligence down here, at least in North Carolina, earnest money, you're going to want some reserves in the back end so that if you do have a major maintenance requirement, you could afford it without immediately being in the water. And your income's not really guaranteed. I mean, especially if you're in the tech industry, which the triangle is known for tech, right? Lots of layoffs happen in the tech industry. Those basic criteria being put aside, right? Like, as long as you have enough in reserves and you have enough to buy, to me, it's a matter of just staying within what you could afford right here, right now, right? Like, if rates get better and housing prices shoot up, well, congrats, you have equity. And then you could refinance down to a lower rate. But like, you don't do that as a game plan. Like, you build that in as a healthy option. The principle is to still buy within what you could afford because you don't know if like a 2008 is around the corner. This is probably the biggest question that I get is people trying to decide when to buy based on the interest rates. It comes down to personal decision. But yeah, I agree with what you're saying. And just principally, I think it's sound.
Yeah. There's so much that goes into it, right? Is this the right location to buy? We may be moving in a year, or maybe moving in two. I've boiled it down to buy early and often, right? If you have the
Hmm.
stomach for it. The quickest way to acquire real estate, right? When people talk about building rental portfolios and stuff, the easiest way is to buy primary residences and do so, within the means of following mortgage guidelines and converting them to rentals when you leave or when you need to upgrade or whatnot. And so if you're waiting to buy, you're passing on opportunities to buy with a primary residence alone. And then if you later on down the line want to acquire real estate, that's fine, but you're buying at a investment rate, which is significantly worse than a primary residence rate. You're buying at an investment down payment requirement, which typically to even beat on a rate sheet that's somewhat favorable, you're doing 20, 25, 30% down versus your primary of 5% down, 3.5% down, et cetera. If you're not buying early and often, like it's hard to catch up because you're passing on these opportunities to use primary residence means of acquiring real estate as primary residence because it's always the most favorable from a financing perspective. And so, yeah, this is the biggest downside of waiting to buy is you're actually passing up on using that primary residence loan.
Really, one of the things that I see most often as well is people asking about buying with low credit. So, with that, I mean, what are your thoughts on that?
So for the low credit options, yes, there are plenty of options for low credit, and we do offer them, right? But a lot of borrowers, I advise like, hey, let's work on your credit, and my advice, whether solicited or unsolicited, is work on that first, work on some savings, get your credit score up, and I and every other lender can get you much more favorable terms. Yeah, I mean, like the low credit stuff, I mean, my honest advice is always just going to be fix yourself. Like, work on your credit and save money. Like, don't, rates are high and homes are unaffordable. Like, now's not the time to be jumping into a house with a 550 credit score and no savings. Is it possible? Maybe. Is there a loan product out there? Maybe. Like, don't do it. Like, I make money off of doing loans. I would do your loan if you're low credit and you're like, oh no, I'm buying. And what's probably going to happen is I'm going to encourage you not to buy. You're going to go move forward with another lender. You're going to get their loan estimate. And then you're going to ask me where I'm at. And if I'm beating them on rate and terms and saving you, like, let's say 1,000 or some money in closing costs, then you're probably going to go with me. So I'll end up doing your loan. But from the get go, I probably advise you to wait and save and improve your credit score from every aspect of it. The more savings you have, more money you have as down payment cash at close, more money you have in reserve after you close. If something goes wrong, talk about risk mitigation, and the better rate in terms you got. Your closing costs are lower because your credit score is higher and you got a better rate on the rate sheet.
This seems to me like it'll probably be pretty simple, but it's still worth asking, right? How does somebody get started on any of these options?
Okay, yeah. So step number one is applying for a loan with a lending company, right? So that's what I do. I do residential mortgages. I focus on VA, FHA, and conventional, and we have fairly competitive rates for those products, and I kind of just stick to those products. Right now, as a broker, I do have access to additional products like DSCR loans, some nuanced products like VA one-time closed construction loans, but those are more auxiliary products that we do offer. Our bread and butter is VA, conventional, and FHA. But you can apply with any lender, right? Hopefully your lender has a couple things going for them, right? Hopefully competitive rates and hopefully really, really good customer service, right? And that comes with good processing times, being available to answer your questions, and having guideline reasonable underwriting, right? And then step number two is filling out that application. Once the application happens, right, it's in the lender's court to request documents from you and then get that pre-approval done. And then when we talk buying, right, you need one of two things to buy. That, let's say realtor, you've hired a realtor and you want that realtor to submit an offer on your behalf. Well, you need one of two things because that realtor either needs to send in with the offer proof of funds, aka I'm setting an offer for 400K. Here's proof of funds. Here's a bank account that shows 400K in it. Or you need a pre-approval letter, right? You need a licensed lender that says, hey, I vouch on this person's behalf. I've reviewed their credit. I've reviewed their income. I've reviewed their assets. I've reviewed their liabilities. And I vouch that they have everything needed for this loan to pass underwriting and close. That's what a true pre-approval letter is. Pre-approvals typically just have a number on them. And that's not bad because it gives everyone a guideline and kind of left and right limits, or maybe just a right limit, let's say, of what they can buy to. But there's also nuance to it. And especially when a consumer is trying to push the limit on their pre-approval, yeah, pre-approval might say 500K. But again, let's say it's in a flood zone and they have to get additional flood insurance. Well, guess what? That flood insurance adds to the monthly debt column. And that could actually mean he's only pre-approved for 482K versus 500. Or there could have been no homeowners association listed in the MLS, and there's actually a homeowners association fee of $500 a month. Well, now that's added to the monthly debt column of the mortgage application, and now maybe he's only qualified for a 40K house because of that HOA fee. So there's always nuance to it, and just because a pre-approval letter says 600K on it, 500K on it, doesn't mean that the borrower can qualify for any house listed at that price, right? The taxes will come into play, the insurance will come into play, any homeowners association fee will come into play. There's additional things that will come into play. So I'm not trying to give realtors too much of a negative view on pre-approvals, but just take everything with a grain of salt and verify pre-approvals, because pre-approvals come in all shapes and sizes, and some mean less than you would think.
So that's all we have for today. My camera actually cut out at the end there. So Mark and I went on for a little bit longer, but the footage is unusable. But with that, everything that he covered is super foundational knowledge to get you started buying a home today. And if you play your cards right, not only can you buy with little to no money down, but you could start investing in your financial future. I'll include Mark's information in the show description. And for more content like this, be sure to comment, like, and subscribe. Thanks.